Hey everybody, it's John King with Summit Funding, and it is Friday, the 21st of July. So we are heading into another hot weekend. Hope everybody has some great fun plans for this weekend. Let's dive into what's going on in the mortgage world. So first of all, the Fed is meeting soon. They're expected to raise interest rates again. Really a reminder, as I've been talking about, we think we're going to stay in a higher rate environment for the next 6 to 12 months. So prepare for that. And really, for people who are looking to buy a home, remember, if you can qualify and find a way to get the payment into your budget, now is a better time to buy than waiting until interest rates come down, because there's not enough homes out there and there's going to be a lot more competition for the few homes. Prices are going to go up. For the people who own a home right now, I want to talk directly to you. I want to have a stark conversation about something I'm really worried about. Your mother and I have been talking. I'm just kidding. I am actually worried, though. What I'm worried about is consumer debt or credit card debt. And the average American's credit card debt has ballooned in the last 2 years. Not only that, but the interest rates on credit cards have shot through the roof. You have a 5.5% increase in credit card rates because the Fed has raised rates by 5.5%, and they're about to raise them another quarter. So you're going to be almost 6% higher in credit card rates than where you were a year ago. That means if you had an 18% credit card rate a year ago, you're at 24% now. If you had a 24% credit card rate a year ago, you're at 30% today. And so I am worried. I'm worried about your budget as we head into and continue in this crazy economic cycle that we're in. I'm worried about how much money you're spending in interest. And I'm worried about people being too focused on, well, you know what, maybe I'll consolidate it, but I don't want to touch my first mortgage because that rate is super low. I'll tell you what, a year ago, I would have 100% agreed with you. A year ago, which is funny because a year ago, rates were maybe at 5.5 to 6. Now they're pushing 6.5 to 7. But the difference is a year ago, home equity loans and lines of credit had significantly lower interest rates than they do today. You're looking at upwards of 10% on the average home equity line of credit. Because remember, they were at 4% 2 years ago, and rates have gone up by 5.5 and now almost 6%. So you're between 9 and 10% on your home equity line of credit. You're 22 to 30% on your credit cards, and yet you're worried about keeping your 3% mortgage rate. I'm not telling you should get rid of that 3% mortgage rate. What I'm telling you is you need to think about your debt in totality. You need to sit down and have a real look with a professional. By the way, I'm a professional. You need to sit down with me and have a look at what is it really costing you per month and how much money are you wasting. Now, I'll tell you what, most of the time when I have this conversation, people say, John, why would I want to take my credit cards and stretch them out for 30 years in a mortgage? I have two simple answers for that. The first one is your credit cards, if you keep making the minimum payment, it's going to take you 30 years to pay it back. As a matter of fact, I've seen on some credit card statements, I saw one yesterday, the minimum payment was $250, but the interest charged was $325. That's an infinity loan, meaning it's never getting paid off if your interest charge is higher than your payment that you're making. So don't freak out saying, oh my gosh, I can't afford to stretch my credit card debt over 30 years. That's a horrible idea. I'll just pay extra every month to pay down my credit cards faster. Well, guess what? You can pay extra on your mortgage. And more importantly is you're actually going to owe less per month by consolidating everything together into one loan. Doesn't mean you have to pay less. What it means is, an example of, as I had a client recently who we paid off $70,000 of debts between a line of credit and tax lien or tax bill that was due and credit card bills. We saved them over $1,000 a month off of their monthly payment. Now, I told them to put that $1,000 back into the mortgage payment, and it would pay their 30-year loan back in 16 years. For the same amount of money they're writing a check for today, they're going to pay their loan back in 16 years. But more than that is they now have the ability to bring that debt down to a lower interest rate down the road. And Fannie Mae, who controls interest rates or at least risk, how much it costs for the risk of a loan, Fannie Mae earlier this year made it way more expensive to do a cash out refinance. Now you're saying, John, you're talking me out of this right now. Why would I want to do it if it's way more expensive? Because the loan you're doing now is a shorter term loan. It's not that it's a short-term loan, it's a 30-year loan, but you're not going to keep it for as long, because in the next 2 years, I expect rates to be in the 5s, maybe the 4s. When the rates are there, that's when you don't want to have to pay a higher rate because it's cash out. So if you had to pay a little higher rate today for cash out compared to what today's market is, that's better, because it's shorter time that you need to pay that higher rate. In a year or two, when interest rates come back down, now you're able to refinance and you get market rate instead of paying the higher than market rate because you're pulling cash out. So it's strategically beneficial both in the short term and in the long term. So if you're sitting on home equity lines of credit that have high interest rates on them, if you're sitting on credit cards that have high interest rates on them, you need to talk with me. Now, I'm going to tell you if it doesn't make sense, but I'm also going to tell you if it does. Matter of fact, I'm going to stand on the table and scream at you and tell you it absolutely makes sense, and there's no reason you shouldn't do this if I firmly believe it. But if the numbers are best where you're at, I'm going to tell you that too. So pull your head out of the sand. Don't pretend it's going to get better later. Interest rates are not going to come right back down. Rates are hopefully going to stop going up soon, but that doesn't mean they're coming back down. You're still going to have this 9 or 10% home equity line of credit. You're still going to have these 25 and 30% credit card rates, and the debt is getting bigger every month. Think about it. Don't hide from it. Face the reality. We need to stop the bleeding before it's too late. So give me a call. Let me help talk you through your options. If it doesn't make sense, I'll let you know. I really appreciate you listening. Please share this with anybody that you know. If you've got somebody else that's a family member that owns a home, they need to hear this message. Hopefully they're not in that position. I hope none of you are in the position where you need to act on this. But I want every single one of you to face the reality of the position that you're in. And if you are in a position that you've got home equity lines of credit at high rates, credit cards at high interest rates, we need to have a conversation, and we need to have it soon. Thanks for listening. Have a wonderful week, and we'll talk to y'all soon. Bye-bye.